Our final discussion topic for the semester takes us away from the business cycle to a discussion of broad historical trends in economic development. In terms of our previous context, economic growth is the expansion in potential output. Now, when discussing economic development, economists think of decades or even centuries, and this is what we commonly mean by the long run. At Core, we will show that economic growth really is productivity growth, is defined that way, and that is driven both by innovation, which is the invention of new technology, and the adoption of this technology. However, in many ways, this definition is a tautology. The more vexing question, and in many ways an open question, is why some nations are better at developing technology and even just adapting available technology that should be readily available. And that is, in many ways, sort of the core question of growth. Before diving into the foundations of growth theory, let's have a quick eagle-eye view at the data. For data availability reasons and conceptual appeal, growth across countries and time is typically measured by real GDP per capita, which also captures average income. We have already discussed the circumstance that we need to adjust for inflation when measuring output over time in a single country. Now, when we're comparing multiple countries, different currencies and exchange rates add to this complication. Now, exchange rate data is fairly widely available. You can look it up online at any day. It's easy to figure out what a dollar trades, for instance, for a euro or for a yen on any given day. But as it turns out, we can't just use nominal GDP in China in a given year, converted to dollars using the average exchange rate, and these exchange rates are sometimes referred to as spot rates, just a daily exchange rate, and then expect to get a meaningful measure, a meaningful comparison. Why is that? Well, for one, exchange rates change a lot on a daily basis. They can move as much as 10, 15, sometimes 20% within a week to another. And clearly the standard of living between two countries doesn't change that dramatically. That's simply a pricing issue that exists in the exchange rate market. But even if we ignore that, this is what we call day-to-day volatility, even if we abstract from that, the purchasing power of a unit of currency abroad can be different from its purchasing power at home. So what a dollar will buy you in China is not necessarily the same what it will buy you in the United States. Let me give you an example. For instance, in 2010, a Chinese yuan traded for about 15 cents on average. However, if it took a dollar and converted it into the equivalent of yuan, that would be about 6.5 yuan, it would not necessarily buy you the same amount of goods in China as it would in the United States. A common example for this is the comparison of Big Macs. The reason why we use Big Macs is because they're sold basically everywhere and they're more or less the same everywhere. And a Big Mac in Beijing and Shenzhen at the time sold for about 14.5 yuan. If you express that in dollars, that would be around $2.18 at the prevailing market exchange rate. More expensive now, this was about 10 years ago, but it drives home the point. At the same time, a Big Mac in the United States sold for about 3.71%. Now, why do such differences exist? Largely they're related to what we call non-tradable goods, and the name really indicates what it is. They're goods that we do not trade. If you look at how pricing works locally, if you have two competing corner stores in your neighborhood, they will approximately sell goods for the same prices. If they didn't, clients would simply go to the cheaper one, forcing the other one to reduce their prices or to go out of business. Now, some of this behavior exists in international trade and it explains trade flows across countries, but for certain goods, trade just isn't feasible. In this particular case, you're not going to fly to Beijing just to get a Big Mac that is $1.50 cheaper. That's generally the idea. Now, how do we deal with this from a methodological perspective? In practice, we correct for differences in purchasing power. If you go to, say, the World Bank's data site, or if you go to Wikipedia, one of the things you'll notice if you look at GDP figures, they are expressed in PPP. And PPP stands for purchasing power parity. The general idea here is to fix prices for production in all countries in some base year, and then trace out relative price changes over time. The details are a little bit complicated, so we'll skip them here, but conceptually this works in the same way as we deal with domestic inflation, where we also pick prices at a given point in time, and then we allow changes in production over time to produce measures of real GDP. Now, if you're interested in the details of this, I recommend going to the Penn World Tables. The Penn World Tables are available for free. They have very long data coverage on growth, and there is a long and detailed documentation section on how these price differences are adjusted for. Now, Assuming that we can do this, real GDP per capita still has certain restrictions. It has certain limitations, as you know. For instance, we exclude informal activities, so anything that is not reported, anything that doesn't leave a tax measure, will not appear in the data. We do not account for measures of income distribution and so forth. Right? We've gone over this list. I'm not going to repeat all of that. Just be aware that these limitations exist. Now, the reason why we still use GDP simply has to do with the fact that it exists practically for all countries, so it is very widely available. And then second, it also displays a positive correlation with other measures of well-being, such as, for instance, literacy rates or life expectancy. Granted, correlation is not one, but it's pretty solid. As a simple example here, let me show you the difference between GDP per capita, income per capita, and inequality. The inequality measure here is the Gini coefficient, which ranks from 0 to 100. Larger numbers indicate more inequality. Now, these are all the countries that we have in the World Development Indicator database that the World Bank hosts. There's a lot of them, as you can see, so it's really difficult to read this. But we have a trend line in here from 1970 to 2005, approximately, countries that had higher income per capita, Qatar, Luxembourg, Norway, and so forth, also had lower Gini coefficients, indicating they had a more equal income distribution. To give you a slightly better sense of this, in this graph on the right, I only included upper income countries and high income countries as by the World Bank's classification. Now, anyone who's exactly on this line is exactly average for their income level. Countries that are below this line have a more equal than average income distribution. Countries that are above this line have a less than average income distribution. And in these statistics, you may be aware of that the United States usually does not rank very favorable. For a country with a relatively high level of GDP per capita, it also has a relatively high Gini coefficient. Countries that you would expect that have more equal distributions are countries like South Korea, they're kind of famous for that. Countries like Norway, Denmark, Finland, the Scandinavian countries. Now, I'm not going to dwell on this too much. Income inequality is an important and a difficult subject, but you should be aware that GDP per capita doesn't tell you everything. It does, however, tell you a lot. That's why we use it. Now, related to the idea of growth is the idea of productivity, as I mentioned initially. What does productivity really mean? In the most basic sense, we often measure productivity as labor productivity. And labor productivity can be captured either as GDP per worker at purchasing power parity, or even better, as GDP per hour worked. It simply indicates how much a single worker can produce on average in a given amount of time in a specific country. The reason why hourly productivity is more useful than just broad GDP per worker is that work hours can vary significantly across countries. So for instance, the United States looks much higher in terms of GDP per worker than Europe than in GDP per hour. And the reason for this is that Americans just work more hours in a given year than Europeans do. Now, this sort of technical complication aside, what is productivity linked to? Conceptually, workers become more productivity if they either have better resources, that is more physical capital to work with, better human capital, that would be training and knowledge to work with, for instance, or if they have better technology. And we'll come back to what exactly economists mean when they say technology. A common textbook example would be the assembly line that with the same amount of resources allowed workers to produce many more cars in a given amount of time. Now, if you look at the correlation between real GDP and GDP per worker, you will see there's a pretty strong correlation here. This is true when I'm looking at these sort of smaller groups of countries as before too. If you go down to GDP per work hour, you again see this relationship emerge. You also see that the plot thins out a lot, and that, as I mentioned, has to do with the fact that GDP per work hour isn't necessarily available. GDP per worker you can measure anywhere where you have a GDP metric and where you have a population metric. All right. Finally, when we're talking about the limitations of GDP, I want to pose a final question without really answering it. And that's the important question, is growth a good thing? Is this really something that we should pursue as policymakers? And obviously, the sort of colloquial way of expressing this, is money really something that makes you happy? Now, at face value, this idea of research on happiness, do we really need to produce more stuff, is a relatively new field. It's been around for maybe 20, 30 years. It's very survey-based in economics, so we can't really answer this easily on a neurological level, which would be the preferable way to do it. And what the finding in this literature is well, Income does tend to make people happier, but there is a constraint. In developed nations like the United States, when we look at measures of self-reported happiness, they tend to increase in survey responses with income. So as people do make more money, they do tend to say they're happier. But that only works up to a certain threshold, and it's probably lower than you would think it is. In the United States, the estimates usually vary depending on the region you're in and depending on when the survey was done, in between somewhere between $70,000 and $100,000. Now, 700 to $70,000 to $100,000. Now, $70,000 to $100,000 is a decent income, obviously, but it's not exactly billionaire numbers either. Past that point, if you offer people marginally more money, they don't tend to report they're happier unless you increase it by a lot. Whereas if you give people 2 million, then there's going to be a difference. But between someone who makes 110 and 120, there is no self-reported difference in income. What this is suggesting is that if you have material need, additional income does make people a lot happier. And that should be intuitive, right? If you have a hard time making rent, if you don't know what your children are going to eat, if you don't know what's going to pay for your education or going to get to work, additional money is very, very useful. If these things are taken care of, additional money doesn't necessarily do much for you. That's sort of the psychology or the psychological explanation behind that. And the same broadly is holding when you look at cross-country comparisons. These studies also exist. And countries like the US actually do rank relatively high in terms of self-reported happiness if you compare them to emerging markets where there really still is often a lot of poverty, or if you go down into the range of countries that haven't developed much at all. Needless to say, if you live in poverty, money does a lot for you. So that's sort of the brief answer here. Of course, there is more to this question. The question isn't per se answered. And then it leads into discussion of externalities as well, right? So this growth does not come for free. We are burning through a pretty significant amount of resources, which takes us into discussion of global warming and so forth as well. I don't want to skip this because I don't think it's important. The reason why I'm going to skip is because we don't really have the time to answer that. Some of this is answered in classes around economic development, which we offer, and environmental economics. Now, finally, I want to wrap up with a brief overview of some stylized facts regarding the growth experience across various countries. Now, the empirical literature on this is gigantic. It dates back to the 1970s, so I really cannot do it justice in full or really even the slightest. But to get a broad sense, if you're interested, go to World Bank's World Development Indicator, WDI database, or the Penn World Tables, all of which are free, and I'm going to post a link, and that provides you with ample just data on the growth experience of countries. The second thing I will point out before I jump into this overview is that the language surrounding growth has been problematic in history, as you may know. For instance, once there was this distinction between first and third world countries, which implied a really inappropriate quality difference across countries and had with it some colonial overtones. Today, the distinction is often one between developed and emerging markets, as well as lesser developed countries. Here, I will start the discussion with the quote-unquote rich countries, by which I simply mean high-income countries, as they're classified by the World Bank, and the World Bank does this by income percentiles. We can separate that from emerging markets, which are somewhere in between, and then lesser developed countries who are sitting sort of at the bottom of the income distribution. And I want to be very clear that the term rich and poor are not intended to indicate any sort of qualitative difference. They simply measure differences in income levels. So to start with the developed countries where we had data for the longest time, macroeconomists started thinking about growth in earnest across the world really only after World War II. And at that time, what neoclassical economic theory, so the stuff you know from micro production functions and so forth, predicted was that differences in the standard of living across countries should disappear over time. This phenomenon is sometimes or typically dubbed convergence. The theory behind convergence is the law of diminishing returns. What's the thought here? I hope you remember what the law of diminishing returns is. It states that productive factors have a larger marginal product if you don't use a whole lot of them. Right? So if you are a carpenter and you have no tools, if I give you a hammer, you can produce a whole lot more. If you already have 15 hammers and I give you one more, it's not going to produce much more. That's in a nutshell the law of diminishing returns. Now, developed countries that have been developing for a century or more often operate very close to capacity, right? We have a built-up capital stock United States. So therefore, the marginal productive capital is much lower compared to countries who have not built up a similar productive structure. The consequence of that is that countries that are further behind on the development ladder should grow faster because they have a higher marginal productive capital, for instance. Now, even if you haven't seen the data, you should anecdotally be aware that convergence, at least unconditional, the way I just stated it, is not something that the data really supports. Let's look at the original evidence that this came from. The first studies that were done in the 1950s identified a bunch of countries that at the time were relatively poor, quote unquote. It was Japan and South Korea especially, that have grown much faster than countries which were relatively rich, for instance, the US or the UK. For instance, in 1950, expressed in $2,000, Japan's average annual income was about 2,000 US dollars in purchasing power, when the US, the respective figure was about 11,000. So the US was a richer country, Japan was not as rich. In 2004, average incomes in Japan had increased to about 25K, which is an 11-fold increase, whereas in the United States, it was equal to 36K. That's still higher, but it's only a 3-fold increase from the 1950 levels. This is what economists at the time meant by convergence. The problem with this is that it doesn't hold for all countries, and that became evident as more data became available in the second half of the 20th century. Bradford DeLong was one of the first one to point out that these earlier studies suffered from what economists or econometricians refer to as sample selection bias, and that means they were not random. Specifically, they excluded relatively quote-unquote rich countries that were rich at the turn of the 20th century, especially in Latin America, but also Central and Eastern Europe, who then failed to converge later, especially because they stopped growing after the 1940s and the 1950s. The Soviet Union is also an example of this. The Soviet Union grew very rapidly until about the 1950s, and then it sort of leveled off. So there are rich countries that have really not grown, and that kind of flies into this face of the convergence argument. That's what we take away from the broader country data sets that we have. Now, the convergence thing aside, I also want to be clear that even in the developed world, growth is a very recent phenomenon. Historically, there's been gradual periods of expansion, for instance, from the 9th to the 12th century in Western Europe, but they were very small and they tend to be very local. Most humans in history lived near subsistence level, and an estimate approximate billion still do. So this is not a thing that we've completely eradicated around the world. Sustained growth, the way we experience it, is a relatively recent phenomenon, depending on which historian you ask. In the West, it's usually dated between 15 and 1700. And of course, there were other periods of growth in the Ottoman Empire or China at different points in history that are not really often part of this discussion, but should be at least mentioned for historical accuracy. But in any case, the rapid expansion of the standard of living that we see, really this abundance that we lived in, we're very far from subsistence level, occurred mostly in the 20th century and is still ongoing, especially in emerging markets and really centrally in China and India. So let's talk a little bit about these other two countries and what the terminology, groups of countries and what the terminology means. The term emerging markets usually refers to countries with still relatively low real GDP per capita that are, however, growing very quickly. The group of countries that is sometimes cited at the forefront since the 1990s are the so-called BRIC or sometimes BRICS country, which include Brazil, Russia, India, and China, as well as sometimes South Africa. Within this group, India and China are the most significant ones. They are the ones that have grown most robustly over the last 20, 30 years. They're also the largest in the group in terms of population. Meanwhile, at the same time, there are still nations that have found it difficult to develop any sort of sustained growth at all, although the number has fallen as well over the past 30 years. Most of these regions are often characterized, I should not say most, but often are characterized by what we call failed government. So there's no functional central government in the sense that we understand it. Many are located in sub-Saharan Africa, often war zones. Some of them are located in the Middle East, and some are located in parts of Southern Asia. Now, economic development in these areas is a critical question, of course, from I guess, a social welfare aspect. And I cannot really pay it the credit it deserves in a macro theory class. I'm going to move away a little bit from that. However, if you're interested in this subject, Priscilla St. Clair offers a class in economic development. She's a little bit more of a microeconomist than I am, and she kind of skips part of the macro literature. But if you're interested in economic development, especially in economic